Imagine the stock market as this massive, intricate clock.
Okay.
Now, what if someone could sort of subtly adjust the gears? Not, break it, but just nudge things so the hands land exactly where they want, just for a moment, to benefit their own, massive positions.
It's
Yeah.
a powerful image. And it's kind of the core idea behind what the Securities and Exchange Board of India, SEBI, is alleging in a recent interim order. It's about exploiting the market's own mechanics.
Exactly. And today we're doing a deep dive into that specific order. It's over 100 pages long, just packed with data analysis. Some really surprising details, actually, about how markets can potentially be influenced.
Yeah, and the focus is on some pretty serious allegations. Index manipulation aimed at a global trading giant, Jane Street Group, operating right here in the Indian options market.
So our mission today is basically to unpack all this complex stuff for you. We'll cut through the jargon, look at the alleged strategies, the sheer scale involved, and importantly, what it all means for, market fairness.
Sounds good. It's a fascinating case study.
Okay, let's get into it. First things first, maybe set the stage. Who exactly is Jane Street Group, and how did they end up on SEBI's radar like this?
Sure. So Jane Street Group LLC, they're a big deal, a global proprietary trading firm started back in 2000.
Right.
They employ something like over 2,600 people now. Offices across the U.S., Europe, Asia, trading in 45 countries. So, yeah, a major, major player globally.
Okay, established, global. So how does a firm like that get caught up in a SEBI investigation in India? What was the trigger?
Well, it seems to have started with media reports. Back in April 2024, there were articles about a legal spat involving Jane Street.
Oh.
Yeah, and these reports mentioned alleged unauthorized use of their own proprietary trading strategies, specifically in the Indian options markets. So those public reports basically prompted SEBI to start digging. They launched a preliminary look into Jane Street's trading activity here.
Looking for any signs of market abuse, presumably. And the main allegation that emerged was this index manipulation. Can you walk us through the timeline? How did SEBI's investigation actually, proceed?
Okay, so April 2024, you have the media reports, and SEBI starts its initial analysis. Then fast forward to July 23rd, 2024, SEBI formally asks the National Stock Exchange, the NSE, to examine Jane Street's trading in detail.
Right, bringing the exchange in.
Exactly. Then in August, SEBI actually interacts directly with Jane Street, and Jane Street submits their side of the story, their explanation.
Okay.
Now, sort of in parallel, on October 1st, 2024, SEBI issues a broader circular. This one was about overtrading in index options, specifically on expiry days.
Interesting timing. So they were already seeing wider patterns, perhaps, even before the specific Jane Street report landed.
It looks that way, yeah. Suggests a growing concern about expiry day activity generally. Anyway, November 13th, 2024, the NSC delivers its examination report on Jane Street to SEBI.
Okay, now SEBI has the exchange's findings.
Right. And by December 2024, SEBI's own observations are pointing towards abnormally high or low volatility, specifically on these weekly index options expiry days. And they notice that certain players, including Jane Street Group, are consistently holding the largest cash equivalent risks in futures and options, especially on those critical expiry days.
So the pattern is becoming clearer. Large positions, high volatility, expiry days. That must have raised some red flags.
Big red flags. It led to the next step. February 4th, 2025, SEBI's team concludes that prima facie, meaning on first impression, Jane Street Group seems to be involved in activities that violate SEBI's rules against fraudulent and unfair trade practices. PFUTP regulations, they call them.
Okay, so a formal preliminary finding of potential violation.
Yes. And just 2 days later, February 6th, the NSE, acting on SEBI's instructions, sends a formal caution letter to Jane Street.
A caution letter, what did it say?
It basically told them, look, you need to refrain from taking these huge cash equivalent positions and stop using trading patterns that could artificially influence market prices. Pretty direct warning.
Very direct. So what happened after that? Did the warning work?
Well, here's where it gets particularly interesting. The interim order notes that despite this explicit caution as recently as May 15th, 2025, Jane Street was still observed running these very large cash equivalent positions in index options. The order uses the phrase in disregard of the caution letter.
Wow. Okay. That suggests, it suggests the potential profits were seen as outweighing the regulatory slap on the wrist, perhaps.
That's certainly one interpretation the order seems to imply. It points to a strong perceived incentive structure.
Okay, quite a buildup. Now, before we get into the nitty-gritty of the alleged strategies, let's quickly cover the basics, because understanding how cash markets, futures, and options interact is, key here, right?
Absolutely fundamental. So you have derivatives, things like options and futures. Their value comes from or derives from an underlying asset. That could be a stock, or in this case, a stock index like the BankNifty or Nifty.
And these markets are tightly linked.
Very tightly. Think arbitrage. If, say, stock futures are priced too high compared to the actual stock price, traders can instantly sell the futures and buy the stock, locking in a risk-free profit.
Right. And that action itself helps pull the prices back together.
Exactly. It enforces a kind of press discipline.
Yeah.
There are mathematical relationships, too, like put-call parity, that basically ensure these markets stay closely connected.
Okay, so they're linked, but things get different on expiry day, especially with options. You mentioned the scale changes dramatically.
Dramatically is the word. On weekly index options expiry days, the sheer volume measured in cash equivalent terms flowing through index options just dwarfs everything else.
How much are we talking?
Okay, get this. January 17th, 2024 for BankNifty options. The options volume was 353 times the trading volume in the underlying stocks that make up the index.
353 times.
Yes, and 98 times the combined volume of the underlying stocks and the BankNifty futures market. It's just a different universe of activity.
That's staggering. And it's not just volume, it's participation too, right? More people involved.
Way more people. Same day, January 17th, over 1.6 million unique participants traded BankNifty options.
Okay.
Compare that to about 4,700 in the underlying cash stocks and maybe 26,600 in the futures.
So you've got this huge pool of options traders, many of whom probably aren't even trading the underlying stocks or futures directly. They're just watching the index level.
Precisely. And a big draw for them is the leverage.
Leverage. Explain that quickly.
Okay, options give you massive leverage. For a very small amount of capital, the order uses an example of maybe 1 rupee for an at-the-money call option right near expiry.
Which means its strike price is right near the current market price.
Exactly. For that tiny premium, you get exposure that's equivalent to holding 1 share of the underlying. Compared to actually buying that share in the cash market, that could be like 100 times leverage, or maybe 20 times the leverage you'd get using futures.
Huge potential gains for a small outlay. But with a known limited risk, just the premium you paid. I can see the appeal.
Absolutely. High potential gains, capped downside. Very attractive.
So let's connect the dots. You have this enormous, highly leveraged options market watching the index. But the index's price is determined by the underlying cash and futures markets, which have way less volume and fewer participants. This creates a vulnerability, doesn't it?
It really does. It's like the tail wagging the dog, almost. If you have enough capital and clout, you can potentially push the underlying market around the dog, which then influences the index level.
Which then impacts the value of potentially massive positions in the much larger options market, the tail.
Precisely. By aggressively trading in the less liquid underlying markets, especially near the close and expiry day, you could potentially engineer the closing index level to benefit your options book.
Okay, so this raises the critical question. How did Jane Street allegedly exploit this specific vulnerability? Let's get into the first strategy SEBI identified, the intraday index manipulation.
Right. This was apparently seen on 15 out of the 18 days SEBI analyzed closely, and January 17th, 2024 is the prime example highlighted in the order. They allegedly made just under 735 crore rupees profit on that single day using this strategy.
735 crore in one day. Okay, set the scene for January 17th. What was happening in the market?
Well, the BankNifty index actually opened sharply down, dropped quite a bit reportedly because of HDFC Bank's results, fell from around 48,125 down to near 46,570 right at the open.
Okay, so the market's weak. How did Jane Street allegedly operate then? The order mentions 2 patches. Let's start with patch I, the morning pump. What happened between 9:14 a.m. and just before noon?
Okay, during this morning phase, the order alleges Jane Street Group went on a buying spree. They aggressively accumulated significant long positions in the stocks that make up the BankNifty index across both the cash market and stock futures. We're talking about INR 4,370 crore worth.
4,000 crore, and they were the main buyer.
The order says by far the single largest net buyer. Their buying apparently accounted for something like 15 to 25% of the total market traded value in most of those key index stocks.
Wow. And did this aggressive buying actually move prices?
Yeah, the order states their trades were aggressively attempting to push up or support the price rise. They give an example using SEBI Bank. Even though the stock price was generally down that day, Jane Street's buying activity alone apparently had a positive impact on its last traded price, the LTP, of over 1,600 rupees.
So they were literally fighting the tape, pushing prices up against the prevailing trend. And what did this do to the overall BankNifty index itself?
It had a significant impact. The index, which had opened way down, actually rallied over 600 points in just the first 8 minutes of trading, rose from about 46,570 to over 47,170.
In 8 minutes.
Yeah, and the order attributes this rapid rise largely to Jane Street's heavy buying in the top index stocks, about 572 crore rupees worth of purchases in just those few minutes.
Okay, so they're aggressively pumping the underlying index constituents, making the index look stronger than it maybe was. What were they doing in the options market at the same time?
This is key. While they were propping up the index, they were simultaneously building large, short BankNifty positions in the index options market.
Short positions, meaning they were betting on the index going down.
Exactly. They were buying put options, which profit if the index falls, and selling call options, which profit if the index doesn't rise above a certain level. Effectively, they built a huge bearish position. The order puts the cash equivalent size at over INR 32,000 crore.
32,000 crore. That's massive compared to the underlying positions they built.
Over 7 times larger, yeah. And because they were allegedly propping up the index while building this short options position, the order suggests they got very favorable pricing on those options. Other traders were apparently misled by the artificial support.
I see. So pump the index, make calls look expensive to sell, and puts look cheap to buy, load up on the bearish bet. Okay, that's the morning pump. What happened in the afternoon? Patch 2, the dump.
Right. From around 11:49 a.m. onwards until the market closed at 3:30 p.m., Jane Street allegedly did a complete U-turn. They reversed and sold practically all of the net cash futures positions they had bought in the morning.
Sold everything they just bought.
Pretty much. Over INR 5,372 crore worth of selling across cash stocks, stock futures, and also BankNifty index futures. And just like in the morning, the order says they were by far the single largest net seller during this afternoon period.
Okay, so aggressive buying, then aggressive selling. This selling must have put downward pressure on the index, right? Undoing the morning's work.
Exactly. It created downward pressure, and the LTP analysis mentioned in the order again suggests aggressive action designed to push prices down this time.
And what was the financial outcome of this whole round trip? The buying and immediate selling in the underlying versus the options bet.
This is the crux of the manipulation allegation. From the underlying trades, the buying high and selling low, essentially Jane Street actually incurred an intraday loss of INR 61.6 crore.
A loss on the main trades.
Yes, but this loss was completely swamped by the profit they made on their massive short options position as the BankNifty index fell during the afternoon. That profit, INR 734.93 crore.
Okay, wait. Using money, deliberately it seems, on the actual stock and futures trades, but making over 10 times that amount on the options bet that benefited from the price move caused by those losing trades. That doesn't sound like normal trading.
That's precisely SEBI's point. The order states this pattern shows manipulative intent. Why else would a sophisticated firm aggressively buy, push prices up, then immediately reverse and sell everything at a loss?
Right, there's no standalone economic logic for just those underlying trades.
Exactly. The order says it has no economic rationale possible to justify such trading activity on a standalone basis. It was allegedly designed to artificially push up BankNifty index, specifically to get favorable prices for their massive options bet.
So the argument is they knew the price pump was temporary, they knew the index would fall when they reversed, but other options traders didn't realize the index level was artificial at that moment.
That's the allegation, that Jane Street was fully aware the prices were artificially up, while other traders were unaware and enticed to deal at those manipulated levels. SEBI calls it a classic case of marking the close, manipulating the underlying to benefit expiring derivatives.
And you mentioned earlier something about FPIs and intraday trading rules.
Yeah, just a contextual detail the order notes. Intraday trading in the cash market isn't typically allowed for foreign portfolio investors, FPIs. The order mentions that the cash market reversals here were done by Jane Street's Indian entities, specifically JSI Investments Private Limited. Just a factual point included in the report.
Got it. And what was the total scale? Across all the days, they allegedly used this intraday pump and dump strategy.
Across the 15 days identified, the total profit from BankNifty index options was INR 3,914 crore.
Wow.
While the corresponding loss on the underlying intraday trades used to manipulate the index was about INR 199.7 crore. The options profit just massively outweighs the deliberately incurred loss.
Almost 4,000 crore rupees.
Yeah.
That's a staggering figure. Okay, let's move to the second strategy SEBI alleges.
Yeah.
Extended marking the close. How is this one different?
This one's different mainly in its timing. It was seen on 3 of the 18 BankNifty days analyzed, plus some other Nifty days later on. Instead of the morning pump and afternoon dump, this strategy concentrates the manipulative activity almost entirely in the final phase of the trading session.
So right near the end of the day.
Exactly. It involves aggressively placing large buy-or-sell orders in the final moments to influence the closing price, which is critical because that closing price is what settles the expiring index options.
Okay, let's take an example. July 10th, 2024. This was a bearish version.
Yes. So for most of that day, say from 9:15 a.m. until about 2:30 p.m., Jane Street's activity in the underlying stocks was apparently relatively muted, pretty quiet.
But then,
From 2:30 p.m. to the close at 3:30 p.m., things spiked dramatically. They allegedly unleashed heavy selling INR 2,800 crore worth of BankNifty constituent stocks, cash and futures combined, and BankNifty index futures.
all in the last hour.
All in the last hour. Their trading volume in stock futures alone reportedly made up over 35% of the entire market's volume in that final 60 minutes.
Huge concentration of selling pressure right at the close. And the aim.
The order says this aggressive selling was aimed squarely at depressing the BankNifty index in the closing minutes. And at the same time, their options position their delta exposure flipped dramatically. It went from roughly neutral to massively bearish, a negative exposure of over INR 44,000 crore.
How did they achieve that flip so quickly?
By rapidly accumulating put options and selling call options. It was a shift of nearly INR 17,000 crore in bearish delta exposure in just that last hour.
And the objective was simple. Push the index down at expiry to make those bearish options pay off big time.
Precisely. A lower expiry value directly boosts the profit on those disproportionately large outstanding BankNifty index options positions.
Any other evidence pointing to this being expiry focused?
Yeah, the order notes something interesting. The total value Jane Street traded on that specific day, July 10th, was about 4 times higher than the day before and 1.5 times higher than the day after.
Suggesting the activity was very specifically targeted at that expiry day.
Exactly. Confirms the expiry-centric nature of the trading pattern, as the order puts it.
And what was the profit from this extended marking the close strategy over the days it was observed in BankNifty?
For the 3 BankNifty days mentioned, the total alleged profit in index options was INR 560 crore.
Okay, now let's bring back that caution letter.
Yeah.
SEBI, via NSE, warned Jane Street in February 2025. But you mentioned activity continued even after that. Tell us about May 15th, 2025.
Right. So remember, the caution letter told them explicitly, stop taking these huge positions, stop trading in ways that artificially influence the index.
Yeah.
But the order states that on May 15th, 2025, which was a Nifty weekly options expiry day, not BankNifty this time, Jane Street was seen to continue to run very large cash equivalent positions, still doing it.
Despite the warning, was it the same bearish play?
No, interestingly, this time it was the opposite, a bullish version of extended marking the close.
Okay, how did that work?
So from about 1:26 p.m. to 3:25 p.m., in the last couple of hours, Jane Street allegedly accumulated large, effective, long cash equivalent positions in Nifty options. This means buying calls and selling puts positioning to profit if the Nifty index went up.
And what were they doing in the underlying market simultaneously?
They were engaged in aggressive and relatively large-scale buying of Nifty index futures and the constituent stock futures. The order mentions figures like INR 4,910 crore in stock futures buying and INR 2,505 crore in Nifty index futures buying.
So buying heavily in the underlying to push the Nifty index upward in the final stretch.
Exactly. Pushing it up during the final 116 minutes, allegedly to benefit their large bullish options positions as they expired.
This really does raise that question again, doesn't it? I mean, what does this pattern, especially continuing after a direct regulatory caution, tell us about the perceived incentives here? It seems incredibly bold, or maybe they felt the potential rewards were just that high.
It strongly suggests, at least according to the Interim Order's findings, a calculation where the potential profitability of the strategy was deemed worth the regulatory risk, even after being explicitly warned. It really highlights the powerful draw of the leverage available in these options markets, where engineering even small moves in the underlying can generate enormous gains on large options books. It's a classic regulatory challenge, isn't it? Sophisticated strategies pushing boundaries versus the rule book trying to keep up.
Absolutely. Okay, that's been a really detailed look. So just to wrap up our deep dive today, we've basically unpacked this SEBI interim order concerning Jane Street Group. We saw allegations of two main strategies, the intraday index manipulation with its pump and dump,
Right, buying the underlying to push the index up while building a short options bet, then selling the underlying at a loss to crash the index and cash in on the options.
and the extended marking the close, which involves concentrated buying or selling right at the end of expiry day to push the index settlement price in favor of large options positions.
Yeah, both strategies allegedly exploiting the connection, but also the huge liquidity and participation differences between the underlying cash and futures markets and the massive index options market.
And the sheer scale we talked about, the precise timing, the fact that they allegedly lost money on the underlying trades, but made huge profits overall from the options. It all paints a very detailed picture of what SEBI considers manipulative intent.
It really does. It shows how these complex, interconnected markets, while efficient in many ways, can also have these vulnerabilities that potentially allow for very specific high-impact interventions if someone has the capital and the know-how.
So thinking beyond just this specific case, this deep dive kind of highlights that ongoing tension, doesn't it?
Yeah.
Between trading innovation and regulatory oversight. Markets get faster, strategies get more complex.
It's a constant evolution.
Yeah. And it makes you wonder, what is the ultimate responsibility of these really large, sophisticated players? And for the rest of us, how can individual participants even begin to protect themselves from potentially engineered price moves?
That's the big question, isn't it? Definitely something for you to think about as you navigate the often complex, always fascinating world